Today, I will be starting our presentation by talking about Task 1. I am Matthew Shalem, and my group members are Paula Levy, Shiva Sundar, and Adam Lee. For question 1, we were tasked with calculating the feasibility of replacing one of the main old production lines with a new one of more advanced technology. To do this, we decided to calculate the MPV and the IRR of the replacement of the production line. This was first done by calculating the cash inflows and outflows for each production line and then subtracting the smaller one from the larger one. For the newer production line, we started by subtracting $5 million in year 0 as the initial cost and adding $750,000 in year 6 as salvage. We then calculated revenue that was generated by this new production line, which started off as $4.2 million in year 1 and grew 4% each year until year 6. After that, we calculated taxes of 40%, subtracted those taxes from the revenue, and got the new total. Finally, we added a $300,000 net working capital cost to year 0, and then subsequent net working capital costs each year that grew 4% annually until year 6. In the final year, we calculated the recovery of net working capital, which was $2,369,488, which we added to the end of year 6. We then calculated the present value of the tax shield, which was found with an initial cost of $5 million, a salvage value of $750,000, a CCA rate of 20%, a tax rate of 40%, and a discount rate of 14%. The total was $1,168,312.38, which we then added to the initial cost. We then calculated the total cash inflows and outflows of the new production line, which can be seen in this final row here. The calculation of the cash inflows and outflows for the old production line was much simpler. We first started with a $600,000 addition in year 0 because this was the amount of money that we could sell the production line at its current market price. And then we had a $100,000 subtraction in year 6 because this was the salvage value that we would forego if we were to sell the product line right now. We then calculated the revenue of the old production line, which started at $2.5 million and grew by 2% each year. We then calculated the taxes of 40% and subtracted those from the revenue and got the total cash inflows and outflows of the old production line. After that, we got this cash inflows of the old production line and subtracted them from the cash inflows and outflows of the new production line. What resulted was the increased revenue from the new line, which can be seen in this final column here. What resulted was the new cash inflows and outflows of the difference between the two projects, which consequently was the increased revenue from the new line. This can be seen in these last rows here. Finally, we calculated the MPV by using these new values that we got from the subtraction of the old production line from the new production line. We also used a discount rate of 14% because since the WACC of the company was 14% and they were unlevered, this would mean their WACC was equal to their discount rate. The MPV that was calculated was $4,753,810.52. Then we subtracted the initial cost of the increased revenue from new line, which made the MPV now $1,222,122.91. After that, we calculated the IRR with the increased revenue from new line, which was 22.7%. And because the IRR was greater than the required rate of return of 14%, which was the company's WACC because they were unlevered, and the MPV was positive, we can conclude that the company should pursue replacing this old production line with a new production line.
Yeah, so for the pro forma, we first had to calculate the total projected increase in sales. We did that by first looking at the new increase in sales from the new production, which was 1.7 million. And then we compared that to the total sales for the company, and it was approximately 21.9%, as we calculated using 2.5 over the 11.3 figure that's up here. And then we got the new production line increase in sales, which was 2.5 to 4.2, which was 68% increase. And then we multiply those two numbers together to get the total projected increase in sales for next year, which is approximately 14.96. And then once we had that number, we could multiply the sales by 1.1496. We did the same with COGS, and then SG&A as well. And then for interest expense, we left it unchanged because it doesn't change with sales. EBT, once again, we multiplied that by 1.1496. And then got the new taxes with that 40%. And then, yeah, new income. We did the same thing for current assets here. So cash was increased by 1.1496. Accounts receivable was also increased by 14.96%. And then inventories was slightly different. It was initially increased by 14.96%, and then we added 300,000 because the question stated that there was an additional 300,000 for the additional year with the new production line. And then prepaid expenses and other assets remained unchanged because they don't directly change with sales. And then we get a new total with the new PP and E, which was once again increased by 1.1496. Same thing with accounts payable here, increased by 1.1496. Accrued expenses, we did the same as well. Notes payable didn't change because they don't affect with sales, they don't go up with sales. Same with long-term debt, it was unchanged. And then owner's equity, common shares, there was no issuing of new common shares, so that was left unchanged. Retained earnings obviously changed, so that was done by first taking the retained earnings from the previous year and then multiplying it by 40% over the net income of the projected net income in the pro forma statement. So 40% because 60% was the dividend payout ratio, so retained earnings is going to be 40%. We get the new total here, and we have an imbalance, which is 641,000 by subtracting pro forma current assets minus liabilities, and then we get a imbalance of approximately 641,000. And then we did the same thing here. I'm not going to explain the cells here, but mainly how we got the new growth rate was through the sustainable growth rate calculation. We had to calculate the return on equity, and then we know the retained rate, which was 40%, 1 minus 0.6, which was the dividend payout ratio. So yeah, 0.4 there, and then once you plug that into the formula, you're going to get approximately a 7.4% increase in sales for this second scenario. And then we did the same thing for the calculations for each of these, and then we get a EFN of approximately 50,000. And to balance that, we once again went ahead and first looked at the EFN, and then we added that to long-term debt. Once you add it to long-term debt, that's going to affect your interest expense. So the new interest expense was calculated by adding long-term debt plus notes payable multiplied by the borrow rate, which was 7%. So the interest rate was 7% according to the question. So that was our new interest expense. Once you change that, your EBT is going to change, your tax is going to change, and your total net income is going to change. That's going to once again affect retained earnings, and then it's going to have a smaller EFN imbalance. And then once you add that back to long-term debt, you're going to get a different number each time, and we do that like 5 times for it to balance. And then finally, it was balanced with these numbers presented here. Once again, similar thing we did for the second scenario. EFN was much lower, so it took a couple of. I don't think it took the first time. It took 5 times. I think this time it took 3 or 4 times for it to balance. We did the same thing, and then the retained earnings changed once again, and then we just balanced it through long-term debt. Yeah, so that's how we balanced the pro forma. For the threshold calculation, we calculated the current total liabilities over total assets from the pro forma balance statement. So yeah, you can see here it was 7.6 approximately over 3.947. And then we get a threshold calculation as 51.82, which is under the 55% range.
Okay, so as for task 4, part A, we recalculate the WACC. So here, first of all, we used the figures from the pro forma balance, which is the total assets and total liabilities, and we also calculate the total equity. So these are based on figures here. total liabilities and equity, which is assets. And with that, we used the R of equity formula to calculate the R of equity, which we plugged in all the different figures, such as the unlevered rate of return, rate of debt, tax rate, and lastly, the debt over equity ratio, which is calculated by this. So total liabilities over total equity. And after acquiring R of equity, we plug this into the WACC formula. And as you can see here as F6. And with this formula, we could easily calculate the WACC to be 13.48%. And as for here, we also used the equity ratio and debt ratio, right? And that is acquired through a formula like that. So equity over total assets would be the equity ratio, and that would be the same for debt ratio. Or you could use 1 minus the equity ratio to acquire the debt ratio. So that's sort of everything we did to acquire the WACC. So that's part A. And for part B, we have to recalculate the NPV and IRR of the first task. So since they are very similar, a lot of the stuff that we calculate here are basically the same as task 1, except for we're using a different WACC, which is the new WACC. C8 is what we calculated here as the new WACC. And the IRR would actually be the same as task 1, which is here. Yeah, and the NPV is slightly different, but it is a little bit higher. So we basically made the same decision as in task 1. Since the NPV is positive and the IRR is higher than the rate of return of the company, we believe that the replacement decision should be made.
For the final task of our project, we had to assess the feasibility of Evergreen's new line that they wanted to implement of baby monitors, in addition to their existing line of baby skincare. So to assess the feasibility of this project, we had to find the NPV and IRR. We calculated first the present value of the tax shield and the salvage value in order to determine these two values, and then assess the feasibility. The NPV is calculated by a few components. First, we must take the operating cash flow, which is calculated by the formula of selling price minus variable cost times units of sale minus fixed cost times 1 minus 0.03. The operating cash flow for each year is necessary to be determined in order to eventually get the NPV. We also had to determine the change in net working capital. Each year's net working capital is 15% of the sales of that year. Changes are therefore calculated each year, and an increase in net working capital is deducted from the cash flow. The present value of the tax shield is calculated by the tax shield formula given in class. The discount rate is also the weighted average cost of capital, or the WACC, at 17%. Depreciation is 20%, and tax is 40%. Thus, we find that the NPV of the project is negative $317,057.32, and the IRR is 5.90%. From these numbers, we can determine that Evergreen should not proceed with the new project because the NPV is negative and the IRR is less than the cost of capital, so this project will not be profitable for them. Thank you so much.